This CTA screencasting project is supported by the South African Institute of Chartered Accountants and the Auditor General of South Africa via the Tutuka program. In terms of IFRS 10, an entity that is a parent shall present consolidated financial statements. So the question is then, what is a parent in terms of IFRS? IFRS defines a parent as an entity that controls one or more entities. So that leads to the next question. What is control? According to IFRS 10, an investor controls an investee when the investor is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. Control therefore consists of three elements. These elements are power over the investee, exposure to variable returns, and a link between the power over the investee and the variable returns received by the investor. All three elements of the definition need to be present before you can conclude that an investor controls an investee. The assessment of control is a continuous process. If the circumstances and facts indicate that there were changes to one or more of the three elements of control, the investor should consider if control over an investee was perhaps obtained or lost. So let's look at an example now. S Limited prepares sushi for seafood restaurants using its own ingredients. However, S Limited decided that they no longer have the capacity to catch tuna on a large scale and identified T Limited as a main supplier of tuna. T Limited signed a contract with S Limited in which they agreed that they will only supply tuna to the last mentioned company and that the board of directors will be appointed by S Limited. S Limited also acquired 15% of the share capital and voting rights of T Limited in terms of the contract. Now the question is, does S Limited exercise control over T Limited? Let's review the elements of control again. The first element is power. An investor has power over an investee when the investor has existing rights that give it the current ability to direct the relevant activities of the investee. In this example, S Limited only owns 15% of the share capital and voting rights. Therefore, the voting rights will not give them power over T Limited. The contract states that T Limited cannot supply to any other entity. This would indicate power over T Limited. And lastly, the contract also states that the board of directors will be appointed by S Limited, which further indicates power. Therefore, we can conclude that S Limited have power over T Limited. The second element of control is exposure to variable returns. S Limited will use the tuna in its own operations and will generate revenue. This revenue is an example of variable returns. Therefore, S Limited is exposed to variable returns. The last element is the link between the power and the returns. S Limited is able to affect these returns, i.e. revenue, through its power over T Limited by means of the contract. We have therefore satisfied the three elements of control and can conclude that S Limited does control T Limited. This is the end of our screencast on control. We thank you for listening.